So, good afternoon, good evening, good morning, depending on where you are. And welcome to the TFI CEPR event on climate change, financial implications for households. I'm Michael Chaliassos. I am very happy to be coordinating the network, the CEPR network on household finance. And I would like to welcome you all to this event. We just finished our first academic session, academic research session. But now I understand we have many more participants, and we are also live streaming this event for the benefit of more people, interested people around the world. I only have 1 minute to tell you that the CEPR network has been very happily collaborating with the Think Forward initiative in the direction of encouraging, supporting research that on household finance that also has some hope of influencing financial behavior and influencing policies in a way that facilitates such behavior and influences also innovation in the financial industry in that same direction. We organize one conference and one workshop every year, and in addition or around the conference and the workshop, we organize a joint event with TFI. In the past, we've done events, for example, on big tech and fintech. We've done events on microdata and implications for macroeconomics and the use for macroeconomics, etc. This time we have a novel topic for us, climate change, and we are very happy with being able to attract a very good group of participants, but also Johannes Stroebel from NYU to run it. But before we get started, I would like to pass the torch to Mark Cliff from ING and the Think Forward initiative to describe a little bit more what TFI is all about. Welcome to all.
Thanks very much, Michael. This is Mark Cliff. I'm the global head of ING's New Horizons Hub. My team collaborates with external experts to develop and communicate research. We cover the themes of consumer behavior, digital innovation, sustainability, and geopolitics. And one of our key activities is leading and driving the research hub of the Think Forward initiative. Now, I know that some of you will be familiar with the TFI, but I would like to take this opportunity to give you a brief outline and update. The TFI is a multi-stakeholder movement with ING, the CEPR, of course, but also corporate partners, including Deloitte, Amazon Web Services, Dell, and IBM. We're devoted to helping people to help them make better financial decisions. We're building on research about how people make decisions, and we aim to develop practical solutions and tools. And we've actually set an initial goal of empowering 100 million consumers. So we have some great ambitions for this, and obviously we're very grateful for the support that the CEPR Household Finance Network gives us in this regard. The TFI operates as an open source platform. All participants are committed to sharing their capabilities. And the foundation of this, of course, is the Research Hub, which organizes and funds a range of short and long-term projects. We then turn the resulting insights into impact through our innovation and community hubs, which develop practical solutions and communication. Now, over the summer, a group of people brought together by Deloitte has undertaken a strategic and tactical refresh exercise for the TFI, with a view to expanding its impact. And I think one of the outcomes is already very clear, which is that we want a closer collaboration between the research, innovation, and our community. The other news is that we're putting the finishing touches on turning the Think Forward initiative into a charitable foundation. Most of the existing partners have already expressed their renewed commitment to this, and becoming a foundation should be a significant boost for the TFI's ability to attract new partners. So, for example, we could be getting partners who are another bank or a financial institution, a B2C company, or indeed a social impact foundation. And we're going to be working hard on this over the coming months. So stay tuned on that. And so to today's event, I'm looking forward to this as it combines two of ING's priority themes, financial health and sustainability. The challenge of climate change indeed exemplifies why we created the New Horizons Hub at ING. It's the very essence of disruptive change. This means that we have to go beyond traditional linear thinking and general equilibrium and representative household models. We need new ways of thinking and multidisciplinary approaches. Indeed, the acronym VUCA, which stands for volatile, uncertain, complex, and ambiguous, might have been invented for climate change. We are facing some unprecedented and non-linear shifts, and this is true not just of climate change, of course, it's true of the policy shifts that could come if we see, for example, Joe Biden winning the election in November. Also think of the near exponential falls in the cost of some forms of renewable energy. But to the focus of today, think also of the potential for disruptive change in individual and household behavior. The pandemic has shown how social norms and attitudes can suddenly shift given the right conditions. As the United Nations Development Programme says, there is no country in the world that is not experiencing the drastic effects of climate change. So people everywhere are affected, and this includes their material wealth and income, as well as their spending, investment, and borrowing behavior. As we also know, financial well-being hugely affects people's small daily decisions as well as their bigger life decisions. In that sense, climate change impacts people individually as well as within their households and families. And in the light of the experience of the pandemic, we should be looking for the triggers for changes in social norms and external advice that might have big effects on household behavior. So I'm obviously looking forward very much to hearing today's panel of top experts discussing these issues. And so without further ado, I would like to thank you for participating in this event. And it's my pleasure now to hand over to our moderator, Johannes. Over to you.
Thank you very much, Mark. And, I think on a day like today, when we all see the images of California burning and San Francisco and Oakland covered in smoke, the importance of more research on, the implications of climate change also on financial market, needs no additional motivation. So let's get right into the event. So we have 4 great panelists who have joined us to share their perspectives. So the way we're going to organize the event is each of the 4 panelists will have up to about 10 minutes for some opening statements, opening remarks. And after that, I will guide a follow-on discussion with the various panelists until about 1 p.m. Eastern time. What we're going to do is, we want this to be participatory and include your questions, but in order to do that, we're going to use a slightly different format to that from the rest of the conference. So rather than, with the rest of the conference, you interrupting and just unmuting yourself, the way we want to do it for this event is if you have a question, if you post it in the chat, and I may then call upon you to either ask the panelist the question directly, or I might group it with other related questions from other people, and I will pose it to the panelists. So let's use the chat function for today. So we're going to start with the opening remarks, and we're going to do those in alphabetical order. So we're going to start out. First remarks are going to be Stefano Giglio. He's a professor of finance at the Yale School of Management and has recently done a lot of research studying the effects of climate change on both financial markets and household finances. So right on the topic of today's panel. So Stefano, over to you as the first panelist.
All right, thank you. Let me share my screen. Okay, do you see my slides? Perfect. All right. So first of all, thank you very much for inviting me to participate in this panel. I think I'm looking forward to the panel. I think it's going to be a great discussion. So let me start right away by saying, there's many channels through which climate risk can affect household finances. And so I want to focus my remarks really on one specific topic, which is how climate risk affects the asset side of household balance sheets. Now, in particular, I want to think about two fundamental assets that most households hold on their balance sheets, which are real estate and the stock market. And for each of them, I want to basically give you some empirical evidence that indeed climate risk affects the valuation of these assets and therefore affects in a very direct way the balance sheets of the households that hold them. I should say this work, each of these two kind of components of my remarks are based on some work that they've been doing with Johannes and with other co-authors. I'm going to be mostly focusing on the empirical side of this. Now, after I talk a little bit about basically the climate risk exposures of real estate and the stock market, I just want to close with a few highlighting a few issues which I think are important when we think about managing and addressing these risk exposures from the household finance point of view. Okay, so let's start with real estate. Okay, what's special about real estate? Well, there are two kind of important issues. One is, of course, real estate is an important asset. Okay, many people hold real estate, is a huge component of the asset side of households. But there's something else which makes it particularly special when thinking about climate change risk, which is that real estate is inextricably linked to location. And location is, of course, a prime determinant of your exposure to physical climate risk. Flooding and hurricanes and wildfire and rising sea levels, these are all risks that are kind of very directly tied to your location. And so it's very clear that real estate is an example of an asset which is very naturally exposed to climate change, and shielding it from these climate risks is extremely hard and costly. And so if we want to try to understand how exposed households are with respect to climate change through the kind of real estate channel, we need to have a good sense of which houses are exposed, which are not exposed. Those that are exposed, how exposed are they? And basically, this is all to say that the measurement of the risk exposures is really a fundamental question. And the literature is now starting to kind of get at this point in different ways. But it's something that is not settled yet. And there's much more work to be done in really understanding what is the right way to measure these risk exposures. Now, in my work with Johannes and the other co-authors, we have taken a stand on this. We tried one way to get to this measurement, which is the following. We took houses located in coastal states, which are kind of very directly exposed to one particular type of climate risk, which is sea level rise. And we geocoded the location of all the houses, and we merged with the NOAA maps on the exposure to the 6 feet sea level rise risk. Okay, so it's really one type, and I think an important type of climate risk exposure. So that's the kind of empirical work that we did. So this is a picture of downtown Miami, and you see a bunch of houses that transacted. Some of them are green, some of them are red. The green ones are houses that, according to the NOAA maps, are not at risk of inundation if with a 6 feet increase in sea levels, whereas the red houses are those that are exposed. So this is one way to distinguish those houses that are exposed to this kind of risk and those that are not. Okay. Now, the purpose of what I'm talking about today is trying to understand, are these assets, is the valuation of these assets affected by this potential exposure to risk? Now, of course, a very kind of natural immediate way to answer that question would be, okay, let's compare the price of the greenhouses versus the red houses. Well, that's not a very good idea, right? Because the greenhouses and the red house differ in many other dimensions. They are not just exposure to this kind of climate risk. For example, more exposed houses tend to kind of concentrate on the beach, which of course has other kind of amenities. So how do we deal with this in our paper? We exploit another dimension, which is a time variation in attention to climate change. So what do we do in the paper is we build a measure of attention at the zip quarter level. So in every zip code, for every quarter, we basically look at how much real estate listings talk about climate change, okay? And basically, we're going to say there's a lot of attention to climate change if a lot of the listings in that quarter for the zip code are talking about climate change. So if you look at the first example here, this is from a real listing. It says the owner holds a letter of exemption from FEMA stating high elevation flood insurance may not be required. Okay, it's an example of the fact that they feel they need to highlight in the listing the fact that they are not exposed to immediate risk from flood. And so what do is we exploit the interaction of the time variation and the geographical variation in climate attention with a within zip code variation in exposure to this flood risk. And basically, to sum up the results, what do we show? We show that when in a zip code climate risk attention increases, the price of those red houses, those that are exposed to flooding, to the long run sea level rise, they drop more than the green houses that are not exposed. And that's direct evidence that indeed real estate prices do reflect the perception of risk that households have about climate risk. That's one way in which climate risks affect households' balance sheets. Another way is through equities. Okay, so a large number of households, are exposed to climate risks through their equity portfolios. And so in a different paper, we explore basically the question of how much stock prices instead that reflect exposures to climate risks. So what we do in this paper is we use environmental scores from different companies, from different data providers, to measure, basically to proxy for the betas of these asset prices to climate risks. We build a climate attention measure, this time built out of the mentions of climate change in the Wall Street Journal. And what we find something kind of very similar, an analog of the results of real estate we find for stocks, which is that firms with high environmental scores, they do better in periods where there's bad news about climate change compared to those with low E-scores. And again, what does it tell us? It tells us that, maybe not fully, but climate risk is indeed priced in the equity market. And by the way, as a byproduct of this, it also tells us how you actually would build a portfolio to hedge climate risk, right? You would basically trade, you would go long short portfolio based on the E-scores that can appreciate in value when you have bad climate news, okay? Now, those were really the core of my remarks was, look, there is direct evidence that indeed empirically climate changes do affect valuation of these assets. I want to spend my last 2 or 3 minutes just raising a few issues that I think are important when we think about both the measurement, but also how should we address these risk exposures from the point of view of household finance. The first issue is an issue of measurement, right? I already alluded to that before in my presentation. We are dealing with very new risks, right? Risks for which we don't have very long time series that is really applicable for the future. And so understanding and measuring what, what are the right definition of risk to use and what are the risk exposures is a fundamental importance for us to be able to do any kind of empirical work on this and understanding what the risks empirically are. And there's recent work in the financial literature trying to exactly understand, how much do the environmental scores tell us, what do they not tell us, and so on. So so measurement is in fact a very fundamental issue because without that we cannot proceed. A second issue that comes to mind when thinking about climate risks and households is a communication problem, which is, are households truly aware of these risks, right? And that's important for many reasons. It's important because, this awareness dictates, for example, where they locate or what do they do with their assets. It's also important in a broader sense because the link between the actual risks and the valuations of assets obviously passes through what investors do. And it passes through the perceptual risk that both households that invest in these assets and institutional investors have, okay? So it's another link that we need to study more and think more about. The third issue that I wanted to raise is the issue of risk sharing, which kind of goes in a sense a bit at the broader level compared to this, to really the households level, which is that, if you remember the map before with the different houses, right, it was a clear example that heterogeneity is important. Some houses are more exposed than others. And that holds at a very local level. But that holds even more once you kind of go to higher levels. Like you can think of globally, right, around the world, different geographic areas are differentially exposed to climate risk. That means that we have opportunity to share risks. And in turn, it means that we need to think about what are the right financial instruments that allows a better sharing of risk around the world. And I think there's a lot of scope for financial innovation to kind of fill the gap here in allowing at the global level better hedging, but also allowing better choices for households in terms of how they hedge the risk they're exposed to. And the fourth issue that I wanna mention, and then I'm gonna close, is the issue of time horizon. The time horizons that are involved when we think about climate change are actually very different from the time horizon that most households think about for most decisions. Of course, there are some decisions like housing where many people tend to have a longer horizon, but it really requires a switch to thinking of different kinds of time magnitudes when thinking about these problems. Okay, and so these are all issues I think are all relevant when we think about the risks that households are exposed to in terms of climate change. And that's all I want to say. I'm going to pass on to the next speaker. Thank you.
Thank you, Stefano. So our next panelist is Nat Kieran. Nat is the Senior Vice President for Climate at the Environmental Defense Fund, and he has also served as Special Assistant to the President for Energy and Environment during the Obama administration. And before his work in politics and at the EDF, he was an academic economist at Yale. Nat, over to you.
Well, thanks very much, Johannes, and thanks to the whole group for inviting me and for putting this panel together. As Johannes mentioned, I've thought about this both from an academic perspective, a government perspective, and now more recently from an advocacy perspective. And I want to make 3 points, and I think this will dovetail with the person I'm guessing is next on the list by my knowledge of the alphabet, because I want to end on this CFTC report that I was a member of and that Bob Letterman was the chair of. But let me make 3 points that will get there. The first one, because I do want to take a broad look at the financial impacts on households of climate change. I think the first point just to make, which is probably one that we all take for granted, but is nonetheless important to recognize, is that there are massive economic damages to the US economy and to the economy more broadly from unchecked climate change that will filter down to households. So I just want to review some of that as a basis. That's different than saying that those represent financial risks. I'll get to that later, but there are massive potential damages to the US economy. The second point is that in contrast, the cost of action, even if we confine ourselves to fairly traditional general equilibrium economic models that sort of take for granted that we're already on the best possible path, and even if we ignore the benefits to the economy from reduced climate damages, the costs of action just on the cost side are much smaller. And I'll talk a little bit about what some of those comparisons have been that we've done at a household level and put them into perspective. And then the third point gets to this report that was mentioned that the CFTC came out with today, or the subcommittee that Bob Letterman and I served on released today. And that is that the findings of that subcommittee report underscore the way that climate risk presents a threat to the stability of the US financial system. And I want to flag one thing relative to what Stefano said. I thought Stefano's presentation was terrific, really interesting, but I want to take a little bit of issue with the idea that this is all about long time horizons, because I think one of the things we need to recognize is that climate change is shifting the probability distributions of extreme weather events that happen this year, next year, the year after. And those extreme weather events, especially if they happen in concentrated areas or so on, can provide, at least a subsystemic level, can provide risk to the financial system. So I'll come back to that. Okay, so that's sort of my outline. First point on the damages. These are probably familiar numbers, but I think they're always worth mentioning. And I'll have a focus on the U.S., but of course there are good numbers for the many of these numbers are larger for the world as a whole. In terms of damages that climate change poses at a macro level to the U.S. economy, one of the useful benchmarks to this was the work done by Saul Sang and colleagues in a paper published in Science in 2017, but based on lots of really good cutting-edge econometric work. And they find, roughly speaking, that every 1 degree Celsius of temperature increase in the long run raises the damages to US GDP. In other words, reduces annual GDP by 1.2%. I think that's probably an understatement, but that's a really interesting lower bound. 1.2% of GDP, of course, is $200 billion. And so if you look at plausible business as usual scenarios that have temperatures rising 3 or 4 degrees Celsius by the end of the century, we're nearing $1 trillion annually in damages to the U.S. economy. And I think many of the researchers, even on that report, would argue that the numbers, as we learn more, that those numbers only get higher. A more recent article by Khan et al., published last year, finds under high emission scenarios, so the sort of upper end of business as usual scenarios, finds a 7 to 14% reduction in GDP per capita. That is a massive economic hit to the US economy that will filter down to households. If you want to think about this as a per ton level, which may be less relevant directly to households, but it's a good sense of the social cost, I would say a lower bound on that is the current value of the social cost of carbon calculated by a interagency working group under the Obama administration. If you account for the real value of money and you look at 2020, so in this year, in today's dollars, that official value, which is sort of a central value of the social cost of carbon, would be $52 a ton. I think if you ask any researcher who's really dug into this over the last few years, on the over-under of whether they think the true social cost of carbon is higher, I think you would find many researchers, including some who were part of that interagency working group, that would say they would put that in the triple digits. I would certainly bet money that when that's next looked at and brought up to date with up-to-date research, that we'll find a social cost of carbon that's closer to $100 or maybe even above it. Bob, of course, has done a lot of research on this, and I'm sure he can speak to it as well. So the first point is that the damages from climate change just to the U.S. economy the potential damages are enormous if we don't take steps to mitigate it, and those will filter down to households. Now, in contrast, as I said, the costs are eminently manageable, even if we ignore even if we don't look only at the cost of ledger, we don't do a cost benefit analysis, we don't take into account the benefits of the economy. And even if we constrain ourselves to general equilibrium economic models, which, as everybody knows here just as well or better than I do, assume that the economy is working well and they're working efficiently from the beginning. Even if you do that, I'll share an analysis that we did. This is 10 years ago, but I think it's useful because it summarizes this from a household level. Some colleagues and I at EDF looked at the estimated general equilibrium modeling costs of the climate legislation that was considered 10 years ago, the Waxman-Markey legislation, arguably not ambitious enough relative to what we would want now, but also that was 10 years ago before the real fall in the cost of renewables and so on. So I think a useful guide. And we looked at the comparison to the household level costs of what we called protecting, health and safety, safeguarding health and safety for American households on a kind of daily basis. And so, for example, if you look at the costs, the outlays at a household level on medical care, social insurance, for example, unemployment insurance, Social Security, national defense, private insurance, fire and police services, we looked at that and fed that down to the household level. That all amounts to about 35 cents per dollar of average household income. So you've got about a third of every dollar of household income going to what we would call securing health and safety for the average American family. In contrast, the estimated costs of action on climate change were less than half a penny per dollar. So that I think puts in not just in comparison to the cost of climate change, but also the cost that households pay and are willing to pay through taxes or directly in terms of securing health and safety. And I'll note, by the way, there could be a robust discussion about, in the long run, I would argue that there's good evidence that if we really take action on climate change, you look at the work of Danny Roderick and others, the technological innovation, the potential impacts on productivity and so on could be positive in the long run from shifting to a different equilibrium where we're really addressing low carbon innovation, again, just on the cost side. Finally, my third point is about today's report. And I know Bob will talk more about it. I'm sure we'll talk more about it later on as well. But I just want to share a couple of things that I think are relevant for this discussion. To frame it, and Bob will talk more about it, the report is, I think, one of the most comprehensive, if not the most comprehensive, looks at the effects of climate, or the potential for climate risk to address to impact the financial system. It is the first of a kind, in the sense it's first report under the auspices of U.S. government regulator to do so, released under the auspices of the CFTC, Commodity Futures and Trading Commission. It does cover the waterfront in terms of U.S. Financial system. So it's not limited to commodities and futures, out of a recognition that all of these things are interrelated. One of the things that I think the report is most interesting in what it does, in addition to a full suite of recommendations that it provides to regulators, is it connects the dots to a degree that I haven't seen done before, either in the US or elsewhere, between the physical and transition risks of climate change and how those could play out in terms of impacts, not only at a systemic level, but especially at a sub-systemic level on the US financial system. And I think this is relevant, particularly relevant to households, because everybody on this call knows, but I think the average reader of the New York Times or the Financial Times perhaps doesn't necessarily think about the financial system that as something that underpins daily transactions for households. But in fact, as all of us know, day-to-day quotidian transactions that drive the U.S. economy, farm credit, small business loans, commercial real estate loans, home mortgages, all of those things are underpinned by the stability of the U.S. financial system, and in particular by the stability of often regional and sectoral financial institutions, agricultural banks, community and regional banks. And I think the report does a great job in tracing at a granular level how the impacts of climate change, including in the short run, as I said at the beginning, the impacts of extreme weather, how those impacts could translate into subsystemic shocks for U.S. financial institutions that would have a very real impact on households. Let me give you two examples. Agricultural drought, we have already seen in the U.S. Midwest how the impacts of climate change can lead to reduced agricultural productivity, to widespread drought, alternatively to flooding, sometimes in the same season. That could present, you can easily imagine scenarios in which particularly dire extreme weather events, particularly dire drought or flood in a given agricultural season, undermines the solvency or the stability of agricultural banks, regional financial institutions that provide credit to farmers and so on. Equally, a second example, one of the points that the report makes that I think is quite interesting is that that local, regional, and community banks hold large concentrations of commercial real estate. So imagine commercial, regional and community banks in a place like Florida or the Gulf Coast, where regions which are susceptible to hurricane impacts, to coastal flooding, to rainfall events like Hurricane Harvey we saw in Houston. It's not hard to imagine a season with a couple of really bad hurricane events hitting one place, threatening the stability of those local real estate markets and perhaps undermining financial stability of those local institutions. So I'll close there, but I want to emphasize that connection that the report draws between physical and transition risks and how those could play out in the U.S. financial system in a way that I think could have real impacts and short-term impacts for U.S. households. Thanks very much.
Thank you very much, Nat. So next panelist is Bob Litterman. He's the chairman of the risk committee at CEPR Capital. And prior to CEPR, Bob spent, I think, more than 20 years at Goldman Sachs, where he had a number of very senior roles in the risk management and research practices. Many of you in asset pricing will know Bob from his work with Fisher Black on the Black-Litterman model. He's the, and as Nat's already mentioned, he's the chairman of the climate-related market risk subcommittee of the CFTC. It was great working with both Bob and Nat on that report, which was released this morning. And I'm sure Bob will mention a few of his thoughts on that report in his remarks, and then we can come back to it in the discussion.
Thank you, Johannes, and thank you, Stefano and Nat, for setting the stage here. And Nat, thank you also for your important work in setting up that CFTC committee. I was shocked when I was asked to, if I would be willing to be chair of this. I was shocked that it was happening at all. And it turned out that Nat was very instrumental in working with Commissioner Rostin Banham in setting this up. So thank you for that. Before we get to that report, though, I'd like to focus a little on household finance. And Stefano, you focused a lot on the, I would say, cross-sectional implications and what is going on right now in terms of valuations. You mentioned the long term, and I look at this from a very long-term perspective and ask the question, how is this liability going to be shared between people today and people in the future? And it gets very much at that issue that Nat raised, which is pricing. Right now, we're not pricing emissions appropriately. We all know that that's inevitable. We're going to price emissions. And when we look at emissions pricing, it turns out it's very important not to focus on expected outcomes. This is all about risk management. It's all about the potential distribution of outcomes and potentially worst case scenarios. Now, as we think about that, it's a complicated trade-off between consumption today and potential impacts on future well-being. I have some slides. Mandy, I think if you can share those. All right, great, thank you. So let's go to the next slide. Now this slide, let me give you a little context. This shows kind of prices today versus prices in the future. And it's part of a report that was published by ExxonMobil about 5 or 6 years ago, maybe 7 years ago now, called Energy and Carbon Managing the Risk. And it was in response to a shareholder initiative that asked Exxon, is it possible that your reserves are at risk? You don't report that in your disclosures. And Exxon said, we'll write this report and explain why our reserves could not possibly be at risk. Not how much risk are they in, they couldn't possibly be at risk. And why not? Because carbon pricing would be so expensive that governments will never move toward a low carbon pathway, such as 450 parts per million. And this page comes from the report. The only thing I added was a little circle around that number 44%, which according to this Exxon report would be the cost to the average American household. And so that's why governments would never price emissions at a level that would risk the valuation or the production of Exxon's reserves. Now, that argument was ridiculous, and I'll let you look at this slide and think about what is wrong as we go through this. First of all, the price paths are not realistic, although I blame that a little bit on traditional economists who look at the world through a lens of expected outcomes. Okay, and if you think there's no risk and you think you know what the costs are associated with different levels of temperature, you might think about choosing between 3 scenarios, 450, 550, 650, and think about a current price and then an escalation at a fixed rate that would lead to that outcome. And you get something like these colored lines on the Exxon curve that show prices for emissions from today into the future. And then what Exxon does is they say, well, governments will never choose the 450 scenario because it would be so expensive. It would cost the average American household 44% of its average income in whenever that green line kind of hits the top, 2100, something like that. Now, what does that math represent? Well, first of all, $1,000 per ton price on carbon, which is ridiculous because even today you can pull carbon dioxide out of the atmosphere at maybe $500 a ton. It's very expensive today, and we don't do it in industrial scale because of that expense. But it's not $1,000 a ton, and you would never charge people more to put carbon dioxide into the atmosphere than it costs to pull it out. But that's just the start of this. Next, we ask, well, in what sense is it expensive? Where does that 44% come from? Well, the assumption is that people will continue to emit the same amount of carbon dioxide when it costs $1,000 a ton as they do today when it's essentially free. That's a little unrealistic. And so you multiply the current emissions times $1,000 a ton, and then you compare that to what? That's happening in 2100. You compare that to current income today. And by the way, I finally want to ask you to think about the logic here. So if these future costs are so expensive that governments would never move toward those low carbon pathways, what should we do today? Should we increase emissions or should we reduce emissions? I mean, this is an atmosphere with limited capacity. So if we're worried about the future, I think you have a higher price today. Let's go to the next slide. Some colleagues of mine, Gernot Wagner at NYU, actually a colleague of Johannes, and Kent Daniel at Columbia, and I published a paper in the Proceedings of the National Academy of Sciences last year in which we looked at optimal pricing paths in the context of uncertainty and reacting to the resolution of that uncertainty. And we get a wide range of prices. You can see here from the low end of 40 to a high end of maybe 140. It was hard to get it below $100 a ton. I have to agree with Nat when you take risk into account. But there is tremendous uncertainty about these prices. And I would just say at the end of the day, taking into account the full distribution and in particular, worst case scenarios, which of course we have no idea what the worst case scenario is. But as in financial markets, we've got to think about extreme but plausible scenarios. And every ton of carbon dioxide that we put into the atmosphere today is likely to have to be pulled out of the atmosphere. In all of our simulations, we're sucking carbon dioxide out of the atmosphere at industrial scale in the very near future. And the issue is, what are the incentives? And these, when we do this work, we think about global incentives and a representative agent. So we're not looking at the cross-sectional impacts, which would probably make the price even higher if you took that into account. Prices do go down over time, of course, because technology makes it cheaper to pull carbon dioxide out of the atmosphere. And also we'll learn more about, let's call it the fragility of the environment. So we may find out in 10 years that it's much worse than we think. Let's go to the next slide. So what are the implications of this? Well, this graph, I think, they're complicated, but I think they're really cut to the chase. What you see on the left-hand side is the past. In terms of, in the top chart, the amount of carbon dioxide, excess carbon dioxide in the atmosphere. So what you're looking at is essentially the Keeling curve, starting in, I believe that's 1900, and we end at 2100. And what you can see is carbon dioxide has been increasing over time. Now, the colors that start emanating look at what would be the expected future path if we started optimal pricing at different dates. So 1980, 1990, 2000, etc. Of course, we can't start it any earlier than 2020. That's where we are today. And you can see on the bottom slide what the implications are for cumulative warming over time. So where we are today is about 1 degree C. And the best we can do, if we were to start pricing immediately today, is about 1.7 degrees. That would be the peak temperature in about 2070 to 2080. So it's too late to hit 1.5. Now, these are estimates, obviously, and there's uncertainty about that. But the point I want to make is the implication of delay. So you can see how high, how rapidly the maximum temperature, and I think the maximum temperature is a good summary statistic for the risk that we create for future generations, and where we are in 2020 and where we'll be in 2030. Now let's go to the next slide. What's the implication of this delay? Well, the UN did a report last year where they talked about the differences between 1.5 degrees and 2 degrees C. And one of the implications I like looking at is the impact on coral reefs, kind of the canary in the coal mine. At 1.5 degrees, which it's too late, we've already gone past that in terms of inevitable warming, you lose 70 to 90% of coral reefs globally. If we get to 2 degrees C, we're going to lose more than 99% of coral reefs globally, which is an absolute catastrophe. In terms of human well-being, I mean, really, that's just an example of the implications for ecosystems globally. And where we are today is somewhere about halfway between those two inevitable maximum temperatures based on when we start pricing emissions. In other words, if we started pricing emissions today, that's where we could get. Let's go to the next slide. Okay, now how do we think about that in terms of cost of delay? Well, us economists like to put everything in dollar terms, and we can translate in a model like this, we can come up with a cost of delay. And the way we do that is we say, let's suppose the representative agent does not follow an optimal pricing path immediately, but rather does it 5 years from now or 10 years from now. And we see the implication on the maximum inevitable temperature. How much would we have to pay that representative agent today in order to generate the same utility that we would have gotten without the delay? And what you can see is, in terms of years of delay, trillions of dollars of lost welfare that we would have to make up And it rises basically quadratically, because for every year of delay, the impacts of the additional carbon dioxide are higher. They grow basically linearly. And also you've got more time. So you're multiplying the time of the delay. In other words, what we'd have to pay, I should put it this way, we'd have to pay a stream of revenue. And the stream of revenue is going over a longer and longer period of time as that delay grows. So the total cost grows quadratically. Let's go to the next slide.
Bob, can I quickly interrupt you? So I think you're going to talk about the report next, and I know that unfortunately Nancy has a hard stop in 13 minutes. And what I want to do is want to give her a chance for her remarks, and then we'll come back to the report, your slides, and the discussion also with Nat, after her teaching. So sorry about that. Our next speaker is Nancy Wallace, who's a professor of finance at Berkeley and the chair of the Fisher Center there. Nancy.
All right, so go to the next slide, please. So I'm going to talk about two pieces of research that we're doing. We've been working on energy and mortgage-related problems now for a number of years. One signature milestone was we were the first Department of Energy grant that ever funded the interface between finance and energy use in capital markets. So this has been a long saga of working with banks. And the second piece is recent work on fire risk. And I'm literally sitting it's 9 o'clock in the morning or a little after 9. The sky is black with a dull orange glow, and there's ash falling. So I don't think our time horizons are as long as people originally thought. This is very real right now, and both of these subjects are issues that are manifest in what we're seeing right now in California. May I have the next slide, please? So the first thing I'm going to talk about is energy efficiency in the commercial mortgage market. Many of the statistics that we've seen up until now are about real estate and the fixity in space, which I totally agree with. But the other feature of the real estate markets is they're heavily levered. So the bond markets that support the real estate industry and most of this investment need to be underwritten. And unfortunately, in the United States, we do not underwrite anything about energy efficiency. Even though energy use is the single largest operating expense for most buildings, we actually didn't even know this until we started this study with the Department of Energy, just figuring out how much energy represented of total operating costs. And we know they're a huge factor in greenhouse gas because the buildings are basically leaking so much energy out of the roofs. So what we found in this whole process is that it's a classic problem of asymmetric information. We're not measuring anything about utility costs, and so lenders have no idea how to price the risk for various buildings. May I have the next slide, please? So our goal here was to try to come up with establishing a relationship that was credible for the capital markets, which obviously are actuarial, that there was a relationship between energy prices, in fact, electricity pricing and natural gas are the two key energy sources that we focused on, their vols and energy consumption metrics and commercial mortgage default. So our initial efforts with banks was they thought we had nothing to say to them. They've now changed their mind, and we're now working with a pilot group of very large lenders in the United States, rewriting their book of business or coming up using our metrics, to rewrite their book of business to think about how they might price this exposure. But the biggest challenge here has been to actually come up with measurement statistics that can be used by lenders that are relatively straightforward, that enable them to think about the connection between the costs of exposure to these energy shocks through the mortgage market and whether or not these pricing impacts are economically important. We find that both are true. These were difficult, next slide please, difficult data sets to put together. And although the numbers look small, connecting all of these dots of including the dynamics of the pricing, especially electricity, at the margin, we know the ISOs, which are the pricing entities for the electricity markets in California, have basically lost control of the grid. So just 3 weeks ago, we had price shocks of $3,000 marginal price per kilowatt hour of electricity. And so these shocks in these markets, which again is coming from weather, the heating and the impossibility of meeting the demand by the current grid, are seriously important. We find, although these look like small pricing implications, we find that these relative sensitivities to shocks in source EUI, which is our measure of energy use per square foot and standardized, it's used by the EPA and by the engineering community, that these shocks lead to fairly small looking, but sensitivities of between 2 and 7 basis points. And just to give some context to that, Fannie Mae has a brand new program, pricing energy efficiency, and they're offering a 10 basis point discount to take advantage of meeting certain restrictions in terms of your relative efficiency metrics. And they're finding huge uptake on those loans. So these are ballpark, but they're important. And when you look at the shocks, the implications for the mortgage market are really important. We're now working on a pilot project with lenders to develop actuarial tables on the debt service coverage ratios that are based on these pricing sensitivities. And the goal here is to come up with metrics that are similar to the earthquake lending scores to actually give cutoffs over which, if you have a given source EUI, you simply would not get a loan from a bank. Next slide, please. So the second piece of this work is looking at the casualty insurance market in California. Again, the connection is back to the mortgage market. These are very large markets. So the mortgage market in the US is something on the order of about $20 trillion. For the US exposure, just for the GSE part of this market, we're talking about a $1.5 trillion exposure just in California and all its risks. And given the orange glowing sky here in Oakland, where I am at this moment, fire risk is an extremely large part of this risk. And again, we find these pricing issues in casualty insurance. The Department of Insurance in California prohibits the use of probabilistic wildfire models for pricing. They only rely on domestic mapping, or deterministic, mapping, and they prohibit the inclusion of anything about tail risk insurance as part of the pricing structure. So this is a big pricing problem in California, which has led to important distortions in terms of where houses are placed and how risk is priced and allocated. Next slide, please. So this is just a quick view that these risks are very dynamic, although the models that California uses are not. These are our forecasts for fire. We're working with physicists. This is a first cut on this work. And clearly this pricing risk is really not incorporated in the mortgage market because the insurance companies currently cover this risk, or have up until now. The issue is whether or not their balance sheets are large enough to sustain this. May I have the next slide, please? We know that the incentives that are in place in California for the pricing and allocation of insurance lead to really large incentives for homeowners to rebuild in exactly the same burned areas where the homes originally were located. Obviously, these policies need to be revisited. We also know that from our estimates of pricing these loans within these areas and accounting for these, the probability of these fires and the effect on mortgage pricing, that the prohibitions on probabilistic models are simply not justified. We know, and this is a low estimate, and given what's going on right now, this is probably 2 or 3 times these estimates. These are large annual expected big fire losses. And it's very unlikely that the insurance companies are going to be sustaining this. And then the prohibitions on the inclusion of reinsurance costs. Insurance markets up until now have treated fire as part of a bundled risk. The reinsurance markets are now pushing back on that, and they want it to be a segregated risk. And obviously this is going to have to be included in the fee structure. So right now, what policyholders are finding is their policies are being, instead of being repriced, they're simply being canceled. And many Californians are being forced into the mutual market, which is a public market and very poorly capitalized. Next slide, please. So just to wrap up, I think, as you've heard from all the other authors that and researchers, and then this amazing study that's coming out from the CFTC, this is going to require long-term commitments for data development with cooperation from market participants, especially lenders, who right now are really not believers in this as a problem, from my experience working with large lenders across the country, with the agencies, including the Department of Energy, California Fire, all the cities that are trying to benchmark their commercial real estate, and other private firms, and also NOAA. So linking these data together with other data providers, and then linking this with the energy market providers and the researchers in these markets. And my experience in the last 7 years of working on this series of grants is that to be effective, academic economists really need to be working closely with financial market participants and developing pilot experiments to help them understand the magnitude of these risks that are currently in their balance sheet. So I'm sorry, I'll have to leave. I have another time commitment, and very unfortunately, teaching comes first. So thank you very much.
Thank you very much, Nancy. This is really exciting work. I think really the mortgage market is probably the primary place and the most short-run place where households are going to see these effects. And I think many of us saw your presentation, your paper just before, and so I think it fits very nicely. Thanks for being part of the panel, and enjoy teaching. Thank you. So I think what we're going to do now is start the sort of the Q&A part, and I want to start out by going back to Bob and hearing his thoughts about the report, and in particular one of the things that that was part of your presentation that we saw already, and one of the things to me that was amazing in the report is that we could actually get an agreement on having as a policy recommendation that you need a price on carbon, and getting a group as diverse, as including BP and ConocoPhillips, and Cargill and many others, to agree that a price on carbon is the right way, as per your prior discussion, I think was kind of amazing. So one of the questions I had for you is, what were your takeaways from the process of writing the report, and what does that make you think in terms of prospects for more regulation to come, and sort of the effects on households that come as part of this? And we have the slide up.
Yeah, great. Can you maybe you can make that full screen now so people can read it? But yes, I think
I can see it well.
Okay, good. The one of the most amazing things to me was that we were able to get consensus. The commissioner asked me to try and generate a consensus report, a high-level report. We were originally shooting for 50 pages. But as you know, when we sat around the table and started talking about what do we agree about, it was very hard to limit the length. And we ended up much longer than that. We ended up with 53 specific recommendations to regulators, not just the CFTC, as Nat said, but also to the SEC and the Fed and the FSOC. And in particular, I would focus on the number one recommendation of the report, which is that the US Congress should put a price on carbon, an appropriate and effective price. And that was something that everyone agreed on as we went around the table, 35 members of the subcommittee representing these institutions. Everyone agreed, of course, we should have an appropriate price on carbon. And we also agreed on a lot of other things. Of course, US corporations should be disclosing material climate risk. And the issue is, what's material? And that's something to which there's no easy answer. We have to develop understanding about long-term risks, because they are different than the way we think about shorter-term financial risks. So we have a lot of experience with market crashes and with the volatility and fluctuations of assets that we can look at historically. What we don't have is a lot of experience with climate change. We do know that it's going to be increasing over time. And if I look out my window, I'm also in the Bay Area. And it's you can actually see it behind me, how dark it is. It's like nighttime right now here in the Bay Area. It's 9:30 in the morning. Normally, I have to worry about the brightness of that window if I'm on Zoom, not today. So, and this is only going to get worse. And I have to tell you, as I think about, do I want to live in California over the next 10 years, or do I want to live somewhere else? The wildfire smoke, which is hazardous right now for the entire Bay Area. And I've become, as everyone in the Bay Area, very familiar with something called Purple Air, a website that shows you whether the air you're breathing is healthy or not. And it's right now, it's unhealthy. And it has been most of the time for the last 3 weeks. Anyway, as you can see on this slide, we've come out with a report that I think is very remarkable in terms of its breadth, in terms of the specifics that we all agreed on, including that we need to establish a price on carbon. But if I just go through very quickly these other bullet points, market participants must plan for extreme but plausible scenarios, of course. Climate risk management is an urgent priority, as I discussed in my opening remarks. The public and private sector must work together, and they should be led by the financial regulatory agencies. The US should coordinate with international regulators. The US should join the NGFS, work with international regulators like the Bank of England, which is really doing very innovative work to try and create scenarios that banks and other financial institutions can use to create meaningful disclosures about climate-related risks. A world wrecked by frequent and devastating shocks from climate change cannot sustain our financial system. Perhaps obvious, but we have to recognize this. And promoting the transition to a net zero emissions economy and safeguarding financial stability are consistent, mutually reinforcing objectives. A lot of financial institutions, asset owners and others, and corporations are now committing to be aligned with a net zero by 2050 transition to a low carbon economy. What that means is we need to price emissions immediately. That's the recommendation of this report, and I hope it gets done. And I'll pause there and turn it back over to you, Johannes or Nat, to respond.
Yeah, I want to go to Nat right away and kind of get your thoughts. One thing that I would be great if you could also address, Nat, in kind of in alignment with, now there's this report, that's the recommendation. One of the things that was striking to me and also to some of the participants here was that the gap between sort of the benefits and the cost of actions are really enormous in both of your evaluations, and yet we've seen relatively little action. So what is sort of the nature of the political failure there, Nat, given your experiences also on the politics side? And how can reports like this push us in the right direction? Can they not? What are your thoughts there?
Thanks. Well, we could probably spend more than a day on the nature of the political failure. I think, I imagine most people have at least done a quick review of the, or at some point in their past in graduate school or whatever, did a quick review of the political economy literature. I don't think any mystery that it is challenging politically to address a problem when most of the benefits from addressing it, not all, but most of the benefits will be out in the future. The perceived costs and some of the real costs will be right up front, when the costs tend to be concentrated on existing incumbents, fossil fuel companies in particular, and the benefits are dispersed among a broad set of beneficiaries. That's a recipe for a wicked political problem. So I don't think it's surprising, although it's frustrating for me as somebody who's devoted much of my career to trying to change this. It's not surprising that we've not seen more political movement, although continue to believe that that the chances will be better next year, like the old Mets, and perhaps with an electoral outcome this November, we will see some shift. I think in terms of this report, I guess I would make two quick points about the politics. On the carbon pricing piece, I think that is a critical recommendation. I think it's terrific to have that right up front in the report. As Bob knows and Johannes knows, I was one of the voices pushing hard for it and making sure we kept it high level and clear. And that's a tenet of my advocacy and EDF's advocacy over the years. I do think that this body calling for that will be valuable. At the same time, I also think that to some degree, what's unique about this report is the focus on the financial system. So I think independently, there's a real clear call for a carbon price, which is really valuable because that can't be said enough times. Congress needs to hear it again and again, especially from a broad and diverse group like this. But I also want to underscore the calls for action by financial regulators. In terms of the prospects of action, I think obviously in Congress, everything depends on the electoral outcome. I think that's almost surely true of regulatory agencies, although there is a point I want to make, which is that the demand from the private sector, the demand from investors, from asset owners, from clients of financial institutions is starting to mount up. One reason why you see the banks and the financial institutions that have taken part in this subcommittee, endorsing and supporting the report, I think, is because they're seeing demand from their clients. So I think that the support, the broad support in the financial community will be important here. Having said that, I think the prospects for action are much greater, of course, if there's a shift in administration. What I've been saying is that, so just to be clear, there's no direct link between this report and action. The report has been presented to the Market Risk Advisory Committee, which is the parent committee of the subcommittee. In principle, it could be filed in a basement somewhere. I don't think it will be, because I think it fundamentally resets the debate about how to deal with financial risk and the financial risk of climate change. And I think that any hearing to consider the nomination of an SEC chair, a CFTC chair, anyone else in a financial regulatory supervisory body next year under a new administration, climate change will be front and center because of this report. So I will expect in any Senate hearing or House hearing, you'll see somebody waving this report and saying, so Ms. Nominee to the CFTC, how would you respond to these? How will you take action on climate? And that's never happened before. So I think this report centers climate in those conversations. Ultimately, it's up to the regulatory agencies, but there's no excuse not to act with this report in place.
Thank you. So I want to go to sort of a broader question. I'll go to Stefano first on that question. So one of the questions that some of the audience members, were interested in is sort of trying, again, put yourself in the position of a household. What can households do, right? So what are sort of the various ways they can adjust their behavior? And then in terms of, potential reallocations in the portfolio, et cetera, what are things that banks can do to help households respond to, help them manage their climate risk, and also the regulatory responses to the climate risk? So I'll go to Stefano first, and then I'll see whether the other panelists have a thought on that. Mute. Step.
I was muted. So there are several things households could do, and on different margins. So first of all, obviously, the choice, for example, of whether you buy a house or not, that's kind of a number one issue, right? You can kind of control directly your exposure. So to the extent you have that margin, you can play on that margin. There you can, if you keep that fixed, you still have several options to kind of hedge and manage these risks. So one of them, of course, is the most immediate one, is to literally, access the insurance markets. And, there was a bit of talk about this before, which is, there's an interplay between your choices and the insurance market. So distortion in the insurance market will lead to distortion in your choice, right? If you can get insurance for free, you keep rebuilding in wildfire areas. And otherwise, part of the work on this work on equities kind of tells us that, I think we're slowly building an understanding of exactly how different financial instruments are exposed to climate change. But you can certainly use equity markets to build some hedges. At the very least, you can try to tilt your portfolios, either by taking some sort of industry bets or, or even within industry, by looking at different companies within the industry, but with different risk exposure to climate change, you can kind of tilt your portfolio, in a way to kind of insulate yourself a bit or hedge some of these risks. Now, what we don't have, which is I think is another topic which is very important, is we don't have a lot of instruments that not only households but even institutions can buy and sell to kind of directly hedge some of these climate risks, partly because we don't fully understand these risks yet, right? But for example, there's no way to bet, to hedge directly an increase in temperatures, for example, right? There are some, weather instruments, temperature instruments here and there, but they are very niche. And so I think there's a whole, there's a lot of scope for financial innovation that I think is particularly important, and it can really help measure, kind of transfer these risks and share these risks at a global level. And then indirectly would be benefit households. You're muted, Johannes.
So I think that's interesting. Actually, one of the things that always puzzles me a little is why the ESG portfolios, some sort of tilts towards, greener energy, for example, and away from coal is just one example of doing this. Why those portfolios are primarily marketed and sold by banks to households as sort of feel-good portfolios, right? You don't want to invest in the sin stocks the same way that you didn't want to invest in tobacco or guns or something 15, 20 years ago. And why they aren't reframed and repackaged and remarketed as here's an insurance, here's a hedge that you can buy against climate change. If you worry about climate change, buy this portfolio and it'll do particularly well when sort of the worst case scenario on this climate risk materializes. So to me, that's an obvious sort of product that banks should go out and offer. The product already exists, but right now it's kind of sold more as like, look, you don't want to feel too bad for investing in coal, and whether and you don't really lose a ton of money in terms of returns you leave on the table by not investing in coal. So maybe we should do this. I think selling it proactively is something, rather than talking about the expected return component of it, talk about the covariance element of the portfolios, and kind of telling people that this is an insurance, a hedge that you can buy, seems like something that banks could do quite easily. I want to see if Bob or Nat have a thought, what can the financial services, the banks do in order to provide either additional products or additional help to households in terms of managing these risks?
Yeah, well, I'm happy to, and I'm kind of smiling because, 7 years ago, I was advising the World Wildlife Fund on how to manage this risk in their portfolio. And we actually put on something we called a stranded asset total return swap, which was basically selling those stranded assets and replacing them with the market in our portfolio in a very simple, elegant, and inexpensive way that frankly households can do through ETFs. There are oil and gas ETFs that you can go short, and obviously market ETFs that you can go long. And this portfolio for the last 7 years at the World Wildlife Fund has outperformed long the market, short stranded assets has had a positive return over 20% per year annualized for 7 years. It's been incredible. So I guess the question for investors today is it fully priced in? This year, well, I haven't looked in the last week, but the market is essentially flat this year, and fossil fuels are down something like 40%. So this continues. And I've been trying to sell it. So why people aren't buying it, I'm not sure.
Can I just elaborate on one additional point on this point, which is that actually we have been, like, in the last few years in a moment in which this is not only was a hedge, it basically was a hedge at a time where people were getting kind of awareness of the problem. And so it was one of the times where it actually paid off. Now, I think the other side of this is in the long run, once this is fully priced in, right, you actually don't expect high return. You should still invest in it because it's a hedge, right? But this concept that and we want that to be the way, right? Because that means the cost of capital for firms that are using, for green firms is going to be lower, right? But I think that, going back to Johannes' point, it's difficult to many people don't understand these concepts, right? And so I think that there's this huge communication issue.
Stefano, while I have you here, I want to ask one question to you. So we've seen a lot of research, today, that you presented, Nancy presented, Bob and Nat presented about stuff that we already know about the relationship between climate change and household finances. And, there's a bunch of PhD students and junior faculty watching this session. And so I wanted to get your sense on what you think are sort of some of the most promising research areas for, sort of young scholars to focus on who want to get into this climate finance research field, and, want to help us better understand the relationship between climate change, asset prices, household balance sheets, and so on. So what would you recommend someone to focus some of their energies on?
Yeah, that's a good question. So I think that there are kind of two main avenues, both on both of which I think we need to make much more progress in the future. One of them is called the empirical side, which is, I think we need to get a much better understanding of what these risks are and what the risk exposures are, and we need to get a better understanding of how do we to estimate and how to get basically an empirical representation of the relationship between all these variables, the prices, the macroeconomic variables, the climate changes. So there's an empirical side, and maybe even more important, there's a fundamentally modeling question that we need to kind of get better at, which is how do we write down models in which both kind of the physical processes and the economic process, like the macroeconomic models and the asset prices all appear together, right? Even though households are in a sense, so households are very strongly affected by how all these variables play together. And I think that in order to make progress in understanding the theory of how climate change affects the economy and households, we need to have a good understanding of how all these, structurally, how these variables relate to each other. And I think basically, I think we need to expand on these kind of integrated models. And I think there's a lot more work to do. And, in the paper on real estate work with Johannes, we have been doing some of that work, trying to say, okay, how do we think about climate risk in a kind of structural way? Is it like a disaster risk? Is it a risk that kind of hits output a little bit every period? Is it a long run risk? I think that we need to be able to write down in some simple forms all these very complicated physical processes and link them to the economy. And that's the work that has been started, by Nordhaus, and I think we can push it forward much more.
Nat, I want to come to you and ask you a question. So one of the things you said in your presentation is that these sort of abatement costs are pretty low on average. And so one of the questions from the audience was sort of how will households respond to this carbon taxation and potentially to carbon dividends? And I want to kind of reframe that a little bit. In some sense, you've talked about the average cost to the average households, but there's going to be a chunk of heterogeneity in there. There's going to be some households who are going to bear a much larger part of the cost. And then to the extent that say a carbon tax gets rebated to households, there might actually be a bunch of people who have more money in their pocket at the end of the day. So first of all, what is your sense in terms of who the winners and losers would be? How do you think those households would react? And then finally, how does that affect the political economy of getting these types of taxes done? I guess we always talk about the carbon tax. We don't really talk about the carbon dividend nearly as much. And to the extent that there might be a large number of households who'd be both better off because they're not breathing, polluted air that Bob's breathing right now, but also because they actually have more money in their pocket, because this tax gets rebated in some form. So what are your thoughts on that?
Yeah, it's a great question. I'll try to be quick because I know we've got lots in the queue. So you're absolutely right. I think it's a great point that the allocation of revenue, if you use an instrument to address climate change that raises government revenue, whether that's a carbon tax or whether that's something like California has in place, which is a cap and trade program that auctions off allowances and raises revenue that way, how that revenue is allocated obviously has significant impacts for the distributional incidence and in particular how households, what households experience. I've long thought, and Bob has really led the charge on the idea of carbon dividends. I've thought that was a great idea for a long time, and indeed, people don't know this, but we didn't do a great job of communicating it, but there was a significant amount of this in over the long run in Waxman Markey. I do think so. The idea of carbon dividends is to return some or all of that revenue back to households. You can do that in a range of ways. You can do that per capita basis. You can do that on a per household basis. You could vary it by region. Just a couple of things so I want to say I think that's very powerful. And Bob, I see Bob nodding. He'll probably want to jump in because he's been a champion of this idea. I think there are a couple of cautions on the political economy of it that don't mean you shouldn't do it. It just means you want to take account of the dynamics as you think about how we're going to get to. I always think about how are you going to get to 60 votes and 218 votes. Maybe we don't need to get to 60 votes anymore. if the Democrats win the Senate and bulldoze the filibuster, but let's use that number. So a couple of cautions about that. One is there are geographic effects. Now those are being studied and those are dynamic. And so I think there's been some shift in the last several years. But certainly the one concern would be you would want to avoid a situation where a dividend allocation to households could be characterized as shifting money from relatively high carbon interior states in the heartland of the US to well-off blue coastal states. Now, there's been some, that's an empirical issue. That's an empirical, and so I think that it's not cut and dried, but that's one thing you want to take account of is a constant per household or per capita dividend looks different in terms of incidence regionally because of the geographic variations in energy use and energy mix. A second point is the time dimension. I mentioned the political economy a few minutes ago. I think there's no question that once you have a policy in place, having a significant or all of the revenues returned to households is a very strong political economy basis and for preserving it. Social Security being the best example. Getting to that point is not quite as simple. I do think that there are some obstacles in terms of getting that point. You face concentrated interests among industries and real transition costs among industries, fossil fuel communities, and so on, that I think have to be thought through. Final point, so in other words, it may not be that you start off right away with a climate dividend, although that's a political question. Final point I will just raise, I think everybody in the climate community and more broadly as well is thinking much more about the uneven impacts of climate change and environmental pollution generally across communities based on race and income. And I think there will be a very strong push if we do see any climate policy, there will be a strong and welcome push to make sure that the revenue allocation is really progressive in the income tax sense, and that it addresses in particular that it's concentrated investments in historically disadvantaged communities. So I think that's an important addition to the conversation that maybe wasn't as salient a year ago.
Johannes,
so one of the things that that kind of links nicely to Nat's last comment and relates to 2 or 3 of the comments in the chat is you talk about sort of the uneven distribution across race and income within the US. There's obviously a related question about uneven distribution globally, and many other countries outside the US are suffering much more from the effects of climate change. You're thinking about households in Bangladesh and so on. And so part of the question then is, those households might have many fewer of the options amongst the things that Stefano talked about, right? Think about hedging your climate risk by tilting your equity portfolio is not really a viable strategy if you think, about a lot of the developing world. And clearly there's a lot of uneven there. There's the typical externalities in terms of, some countries reduce their emissions, the benefits go to everybody. I guess we've seen some beginning and then retreating from in terms of global collaboration on some of these issues with the Paris agreements and so on. What are sort of what do you view there as the prospect? Again, thinking now about households, individuals in the developing world, who really don't have where it's not through the mortgage markets, it's really about their sort of daily livelihoods. Any thoughts there? Sort of a broad open question then.
Yeah, I'll begin very quickly. Clearly, the incidence of climate impacts will hit much harder on poor, globally poor, the global South, globally poor communities, and even within the global South, of course, which is hugely heterogeneous. Poor communities, Bangladesh, some enormous number of Bangladeshis, 30 million or something, live within 3 feet of sea level. You look at reports by the World Bank and others that show huge impacts, negative impacts on agricultural productivity across sub-Saharan Africa, which is one of the places that can handle it least well. You see threats to tropical forests and the people who depend on them in the South America, as well as Indonesia and so on. So I think it's clear that the incidence globally, and it's an important point, is vastly uneven. How you address that, again, is complicated. 10 or 12 years ago, there was lots of talk before the Copenhagen conference that we were going to have some, you're going to have some grand redistribution through global carbon markets. That's a wonderful scheme in theory. Politically, it's never going to, it faces even more enormous problems than we talked about with respect to the US. So I think that, the transfers, some of that will be through traditional overseas development assistance. You're already seeing that be ramped up. So a lot of this will happen through traditional overseas development assistance that gets more and more focused on climate resilience and climate adaptation. But there are also some, small amounts relatively to the global flows of finance that go to support resilience and mitigation in developing countries. But I think this remains a real global concern, and it's hard to see how we overcome that in a structural way. The Paris Agreement, it's worth noting, I'm a big fan of it. Not everybody is, but I'm a student of international relations, and I think it's probably about the best kind of framework you're going to get. But it very much relies on decentralized national action. It is not about top-down negotiations and transfers of funds, because that's not how the international system works.
Bob, so we're coming to the end of our time. So I want to come to Bob one last time with a question from the audience that I think is a great way for kind of, your sort of concluding thoughts on the issue, which is, thinking about the concrete implementation of the main messages, correct carbon pricing, correct insurance pricing. What do you view as the next steps, sort of concretely, where do we go from here? And any other concluding thoughts that you have?
Sure. The urgent next step is globally harmonized emissions incentives to reduce emissions. And I think carbon pricing in the US is the first step toward that. My feeling is that although this international coordination effort is very complex, and Nat is much more of an expert, and I'm sorry he's as uncertain as he is, but I think the rest of the world, particularly Europe and China, are ready to move and have indicated as such and are waiting for the US. I think the US is ready to move. I've talked to a lot of folks, in the privacy of their own office. This is something where there's at least, a dozen Republicans in the Senate today who would love to have an opportunity to vote for a price on carbon. And so I think that will happen after the Democratic wave that I expect in the next election. And so I'm actually relatively optimistic. And just to give you an example, the Climate Leadership Council has a bipartisan plan that has been supported from everyone from ExxonMobil to the World Wildlife Fund. And, I think that plus the entire economics community, you saw the entire financial market community say we need a price on carbon. I think it's going to happen much quicker than people expect. And that will then lead to, I think, a coordinated attempt to create globally harmonized emissions at an appropriate level, which is much higher than where they are today. And one of the things that I'm looking at actually right now at my firm Kepos is what we call a carbon barometer, which is a measure of what's the average incentive to reduce emissions globally. Of course, it's much too low, but it's not just a question of carbon taxes. It's also, what about subsidies to renewable energy? What about fuel taxes on fossil fuels? And there are huge subsidies and taxes on both sides of the equation. When you added them up 5 years ago, they were essentially zero. Where they are today is essentially about $12 per ton. And I think they're going to move up dramatically over the next 2 to 5 years. So I expect that we will see, significant incentives to reduce emissions over the next 5 years, and that will lead to the, transformation of society that we all expect.
Thank you, Bob. I think those are, beautiful final words. I think we're unfortunately out of time, so apologies if we didn't get to your questions. I want to thank Bob, Nat, and Stefano, and also Nancy, who had to go and teach her class. Thank you so much for your time and the insights. I think there is, a lot of things we already know. I think some hope that we're going to see some of these policies implemented, with the hope that will, over the long run, reduce the financial impact of climate change on households. households, either through, reducing the asset value declines that come alongside it, through making insurance more affordable, and through reducing the needs for households to take mitigating actions themselves, right? So this is one of the things we talked about a little bit also in Nancy's presentation, right? If there's nothing that happens, you will have to move away. You have to move out of Florida. You have to move away from California. This uproots entire communities, has enormous costs on, on those households, both financially and non-financially. And so I think some of these policies that we've talked about, I think, have the potential in the medium to long run to help this. So I think lots of ideas, lots of hope, some research ideas hopefully as well. And so I want to pass it back to Michael, maybe for some concluding thoughts from the CEPR. Thank you very much.
So thanks very much. I mean, actually, we have reached a peak, I think, with excellent remarks and excellent conclusions. I want to thank all the panelists and you, Johannes, for putting this together. And I want to thank also Samuli Knupfer for his brilliant idea to recruit you, Johannes, to put this together. So let's hope, for more international collaboration, as Bob suggested, and all the other panelists. And let's hope that households will get the right incentives to participate and the right opportunities to manage their risks. And I want to again thank everybody and invite those of you who are interested in the academic research part of the conference to join us again tomorrow at 3 p.m. Central European time for the continuation. Thank you.